Thank you, Bettina. Good afternoon, ladies and gentlemen. Also, I think on my behalf, but also the whole team. And as you can see, the team is larger than last time. Michael and I are still the same, but we're very pleased and honored to be joined now by Christina Johansson, our new CFO, who I'm sure you've read about, but many of you probably haven't yet met. And this is a chance not only during the presentation, but of course, obviously afterwards. And then also Duncan. Duncan, a lot of you met, I think, last year in June when we had the Capital Market Day here in Frankfurt at the trade fair. He'll explain a bit more about himself, but we're also very proud now that by having added another member and by also us having added another year to our experience curve, we now have over 100 years of competence in the industry. So I think a good team. Not only 100 years of competence, but 100 years of experience. We've been through a lot of what we have ahead of us, and I think that makes us really well prepared for the future. It's my pleasure to walk you through the headlines, and then, of course, Christina is going to dive into the details. But I think our single biggest headline of 2018, and I know the financial community may look at it differently, but for us it was definitely the fact that we completed our DPA, or to be more exact, our extended DPA. So you will have read when we proudly announced early December that the monitor had certified us. And what does the monitor certify? He certifies that the company is on an irreversible course to self-sustaining compliance. Doesn't say we're perfect, but he says we've got systems in place that we're now able to deal with compliance ourselves. And why do I say that? Because compliance is a journey that really never ends. It's like health and safety. The day you say, okay, we're there, that's the day you have your accidents or your incidents. And that's why for us, compliance has become part of the culture of Bilfinger. And I think it's not only the culture, but it also has given us self-confidence. Some years ago, people doubted whether we could make it. We've shown we can. We made it by ourselves. Yes, we had some outside help. We had a lot of guidance from Dr. Lifchitz. But in the end, it was our team that took us there. And our team was led by Olaf Schneider. Olaf, raise your hand again. There he is, okay, our Chief Legal Counsel. For those of you that want to learn more about compliance later on, he's the go-to guy. It also means, of course, that with our systems now in place and our newfound confidence, we feel prepared to go back into places that we left before. One of those is China. You will have read about our intents on China, that we're establishing an office in Guangzhou to support our biotech market. Biopharma units are selling into China, and as we sell more, we need to support those sales. You've also read about scrubbers, which we'll go into a little bit more later. Scrubbers are the catalysator, the cleaning mechanisms used in the marine environment to clean up their environmental act. And a lot of those will be installed on ships in Chinese dry docks. Now, we wouldn't have trusted ourselves to do that some years ago, but now, of course, with compliance in hand, our newfound confidence and systems, we feel ready to do that and ready to go east again. Of course, the financial highlights, again, no surprise. You saw the numbers this morning. Very pleasing, I would say. But I use the word pleasing, not yet satisfied. We have a way to go. We're roughly at the halfway mark on our 2020 strategy that, in fact, we unveiled 2 years ago to the day, February 14th, 2017. We came out with our strategy. And as you'll see as we go through this, we really haven't changed our aspirations or our own expectations. But for 2018, the highlights, of course, orders received. We beat our own expectations. You recall the outlook there in the middle of the page, mid-single digit. We topped at actually 12.5 if we go to the decimal. So that's why we give ourselves 2 green check marks there. Revenue also grew. You recall in our 2020 strategy, our CAGR for the whole period was 5% CAGR. We did 6% organic growth in 2018. So again, we give ourselves 1 check mark. EBITDA adjusted, we kept it in the, as we say here, significant increase, mid to higher double-digit million amount. And then in Q3, at the end of Q3 rather, we became a little bit more precise and said it's going to be in the range of 50 to 75. And we're right bang in the middle of that with our 65, another check mark. The final box was free cash flow adjusted. And our target at the beginning of the year was to get to a break even. So if we'd seen a 4, 5, 6 there, we would have been happy. We see a 5 and a 6, 56. So I think we did well. And it wasn't just by not paying people. We did well in efficiency, in driving our collections, reducing DSO. And Christina will show you more details on that. So I think overall it was a year where we were able to achieve our expectations. We're able to check the boxes, not only the large ones here, but also a lot of the small ones along the way, and make good progress. If I drop down a level now into Q4 performance and how that translates going forward, I think some of you didn't expect that we would do as well in Q4 on orders received. To be honest, neither do we. You recall at the outset of the year, we expected Hinkley Point to feature in our order intake in 2018. That was shifted into 2019. So then we were also holding our breath a little bit. And the fact is that both Q3 and Q4 in 2017 were very strong quarters. So when we were able to show that in this year, or rather the end of last year, Q4 2018, we had an organic increase of 3% over the relatively strong quarter in the year before, we were very pleased with our sales team. And I think it shows that our strategy, our focus on the industries, but also our investments into business development is really beginning to pay off. On the revenue side, it translates into revenue with some time delay. Obviously, we take in long-term service contracts, we take in projects, and of course, for that to filter through to revenue does take a while. But with a book-to-bill ratio of 1.07 on the year, we're confident that not only does that fuel our revenue growth for 2018, but it puts us in a very good position for 2019. When you look at our backlog, organic increase of 12% at year-end 18, again, it gives us confidence, and therefore, we continue our momentum. We're not going to go crazy and accelerate out of control. We're going to continue at our pace and deliver on what we said we would deliver. The adjusted EBITDA, significant increase. Okay, that's not difficult because you recall in 2017 we were at 3 million. You recall why. We have our project management to 99% under control. You never have it completely under control, so we don't dare say 100. But we've installed the systems to make sure that we deliver our projects as predicted, and therefore the pickup in EBITDA is to a large extent a result of not having those kind of mistakes and actually delivering what we said we would do. And once again, in Q4, it was our strongest quarter. Not quite EBITDA adjusted as high as the prior year, but the prior year had some adjustments. So when we look kind of beneath the effects, it was a good quarter, and we were pleased, but also not yet satisfied. Then finally, net profit. I think the fourth quarter net profit adjusted was the first time that we actually got through the zero line since 2014. But for the year, still negative on the net profit unadjusted line. We think we're on the way to that, and of course, we've also significantly improved over what we did in 2017. Moving on to liquidity, and as already mentioned, our cash flow improved significantly, 56 million for adjusted free cash flow. Large part of that was the fourth quarter performance. As in many other previous years, the fourth quarter is outstanding. We always hold our breath between Christmas and New Year, and I think all of us were looking at our emails daily to get the cash report, and then when it came in, it was really Happy New Year, we're on the way. Christina will show you more details, but as I mentioned, 14 days of DSO improvement went a long way to driving that number. Our balance sheet remains relatively solid. It's performing again as expected. We concluded our share buyback last year. That was 150 million, which ran out in October, again as planned. We've also, on the basis of the numbers you've seen and on the basis of our balance sheet, we've proposed to the supervisory board €1. They will propose that to the AGM to be held on the 8th of May in Mannheim. And that would then be the third year in a row that we've paid the €1 kind of basis. Going forward, of course, we expect to do better than that. But I think, again, it reflects the fact that we have confidence in our balance sheet, we have confidence in our planning, and that we return some of the money, especially some money that we took in late 2016 with the sale of Apleona. We return that back to the shareholders. Our outlook for 2019, as I said a few times in the meantime, is fueled by the strong order book. It's fueled by the progress on our strategy and our improved operating performance, and more of that later. But in a single number, we expect to have a baseline, if you like. We expect to do better than 100 million adjusted EBITDA in 2019. And with that, I would pause and ask Christina to get into the details on the numbers.
Thank you very much, Tom. It's a pleasure for me to present the numbers for Bilfinger for the first time. I started off December the 1st. I don't think it's the best time for a CFO to start off. You come in and you feel that you would like to change one or another thing, but you can't really change much going into the past year. And I was focusing on the cash side because that was where we saw at the end of November here we need to strengthen whatever we can in December to improve it. And I will come back to the good and the bad sides of me also pushing the cash in December. But let us start off on the order book side. I think here we exceeded the expectations. And as Tom was saying, we closed 2018 having a 10% increase versus last year, organically even above 12%, so 12.5%, extremely good and also motivating now going into 2019, having a very solid base load for 2019 and a lot of the work that we need for 19 already in our books. Especially worth mentioning that we had a strong order intake from both sides, from both our segments, but especially on the E&T side coming in. Book-to-bill, we closed the year 2018 with 1.1, and our order backlog at the end of 2018 was 11%, 12% organic. So very, very good start of the new year 2019 then. If we look at the revenue side, we also here managed to achieve the expectation of the 5% increase in revenue year by year. We even organically closed at 5.7%, so very strong performance. On the EBITDA side, we closed the adjusted EBITDA at 65 million, 1.6% margin, which was a good step forward. And as mentioned by Tom, the last quarter, which belongs to the strongest ones year by year, as we have some seasonality, was also a very good performance with 3.3% profitability adjusted EBITDA, slightly below what we had in the same quarter 2017. However, in 2017 we had some projects that were closed and generated, I wouldn't say a special profit, but an upside in the very end of these projects. Looking then at the reported EBITDA, we are closing at -7, so we have 72 million special items or adjustments included here. That is to compare with previous year where we had 121 million as adjustments. So we are going in the right direction here clearly. Most of these items are continue to be related to the sale of some of our legal entities. The effect of that, we are showing it here, 17 million. The rest related to compliance, to IT system that we are rolling out over the last years, and also restructuring cost. And obviously it's a clear target here to reduce this amount year by year to get closer between the adjusted and the reported EBITDA. So a big step forward here, and if we then continue to look into the two main areas on the cost side, We are looking into the gross profit, where we in our 2020 strategy have said that we would like to improve our gross profit with 2%. We managed to close with a margin level in 2018 of 9.4%. Previous year we had 8.4%, so 1% improvement, which is good, but we also have to be honest and say that this is an area where we will need to get more out of this going forward in the next 2 years, and that's a lot of the focus for our COO, Duncan Hall, to make sure that we are getting more out of the existing contracts and projects that we have. So here we haven't made the progress that we would like to, but there is more to come, and I think there are a lot of activities in many of our entities to improve this. This is obviously a combination of executing what we have in the order books in a better and more solid way, looking for more profit on these contracts, but also to pick the development areas that are more attractive, those that are generating growth, but also those that are generating a stronger margin than the average here. And we will hear more about that from Tom in a minute. So it's a combination of this, and obviously also, as we have a strong order intake, to in some cases also train our people to get a bit more picky when they are taking up new contracts, to be more selective. So it's nice to be in the position that you can allow yourself to do that. Then looking into the next area, beside the gross profit, we are also looking at the Sgna, where we have said in our strategy that we want to get 3% EBITDA improvement out of this. And looking what we managed to perform in 2018 from an absolute number, we are at the same level. However, we need to keep in mind that we had a growth, so we didn't increase our Sgna with anything due to the growth. And we also had, if we compare year by year, in 2018, 20 million included for further business development and digital next. So we managed to do more out of this money. But this is an area that I will focus on a lot going forward, because I definitely see that there is potential to get more out of this. And if I remember from the strategy that was presented in 2017, we would like to get down to the level of 7.5%, so there is at least another % to get out of this. Then looking into the two areas. Starting with E&T, which made a good progress last year in regard of getting order intake up, increasing the order books. So we are talking about an organic increase in orders received of 34%, and we are talking about 33% organically in the order backlog. Also on the revenue side, last year we had an organic growth of 8%, significant contribution from North America. And also in regard of the margin, we were then ending up at a level of 2.2% in the adjusted EBITDA here. A very, I think, a good step forward, and we will also compare this obviously when we are coming to the point later on the new changes to our organizational structure. Then looking into the larger segment, which would be the MMO, here we had an increase in the order books of organically of 9%, order backlog with 6%, and the revenue also with 6%. EBITDA adjusted margin, we closed at 4%, and we had especially here a very strong performance coming from the region Northwest that Duncan Hall just then left at the end of 2018. So a very strong performance, and especially in the last quarter, this division performed extremely well. Last but not least, to make the calculation work, we also have the area OOP. Here, a lot is legacy. the legacy is getting less and less, which means that 13 legal entities have now been disposed or terminated until the end of 2018. We have 4 left that we hopefully will be able also to close in 2019. 2 of them have already been solved in the sense that 1 is signed and 1 is closed. So we are quite hopeful that this work will be finalized until the end of 2019. We also have then the performance of these entities here, and here you see obviously that getting less and less entity into this division, you see that we are moving down on the profitability, but also on the revenue line and order books. The profitability was a little bit burdened here this year and not improving because we have 1 legal entity that belongs to the remaining 4 this year, which has not performed very well, and that is South Africa. But that's a structural problem in the utility business in South Africa, and it will be solved, we hope, until the end of 2019, as we are trying to sell off this entity. Then going into cash and the cash generation, we have also here a strong performance, a lot related to the last quarter. So the voice was heard in December. We need to get more cash. Some did it in the right way, worked a lot in December also on reducing the work in progress and the DSO. Some of our divisions, however, also took a part of that improvement by using the suppliers a bit more than they had before. So we have an improvement if we look at Q3 versus Q4 on the DSO side. But if we look at comparing 17 to 2018, we are more or less at a similar level. And we are, of course, here in the DSO, including also the prepayments and also the VIP. So it's not only the accounts receivable. This is also something that I'm sure that we can further improve our developments on the DSO and get more cash out of the working capital. But as we are showing also on this slide, you see the development of the accounts payables, and also here in December we had more accounts payable hold back at the end of December. So it's a combination. If we look at the development of the cash flow, you see it on the left hand, on the corner, you see the improvement, the adjusted operational cash flow moving up to 110 compared to previous year with -7, which is a step in the right direction, but also here more to come and more to get. On the cash side, extremely important, improving this further quarter by quarter as we proceed in 2019. And if we look at the reported and the adjusted net profit, we see the reported numbers -24, previous year -89, adjusted net profit moving up to 36 versus -9 last year. And the free cash flow almost reached break even. We ended up at -4. Last but not least, looking into activities that will bring us further improvement. Nothing new here, it's ongoing, and we have benefited from these activities already, but there is also more to come. So we have the IT projects. Most important part here is the harmonized, standardized ERP system that we started to roll out in 2017. We have by now, by the end of 2018, a degree of completion of around 40%, targeting to get to 70% by the end of this year. Extremely important to also reduce our cost, but also to improve the transparency. We have seen in those entities that have the implementation that, for example, transparency on the working capital has improved a lot and helped us also to, in reality, get the cash in earlier or get more cash in. Then looking on the procurement side, continuous improvement here. We see increasing number of e-auctions. We are also trying to bundle the procurement more and more. Bigger is better in the sense of better pricing, and we will continue to drive this a lot on the operational side. In some cases, we are obviously also buying for our clients. This is an area where we also with the increasing activity need to get more margin out. Merger of operating units. Since 2016, there has been a strong drive to reduce the number of legal entity, to reduce complexity in the Bilfinger Group, but also to, of course, make savings and getting less units with a more clear and larger size, all to make sure that we have a good offering to our clients, but also on the HR side to make sure that we are able to be attractive for managers that would like to join us. Having a clearer, bigger size, it will make it easier for them to also drive the business. And as you can see on the right-hand side at the bottom, we started off in March 2016 with 279 legal entities. We were at the end of 2018 down to 168, but the drive down will continue. One very good example that just went live is Austria, where 5 legal entities at the beginning of 2019 were merged into one, which gives us a completely different size in the Austrian market, but also helps us then, of course, to be more efficient in all our processes. So this work will continue, and these activities here and initiatives will continue through 2019, 2020 as fast as possible to also support the development and the turnaround of Bilfinger. Then I would like to pass back to Tom.
And it's my pleasure to share with you a little bit more insight into the way forward. We stick to our strategy, and we say that at the outset, 246, but we did take the opportunity in 2018 to look a little bit deeper into a number of companies. And if you recall our initial slide in February 2017, 2 years ago, it's really the detail on the left there. At that time, we said that we spent quite a lot of time going deep into the company, analyzing. We shared with you what we found and our way forward, in other words, the roadmap of Strategy 2020. That allowed us to work on the biggest areas, most significant areas first with a sense of priority. And then as they became under control and we kind of exited the stabilization phase that we talked about early last year, we then said, okay, now let's go to the next level of detail or granularity, if you like. And we began to select certain entities. We this time took outside help. We didn't do that when we created the strategy. And we then dispatched teams to key entities around the Bilfinger world to look a little bit deeper. We didn't always like what we found, but it certainly gave us a lot more clarity and granularity. And as a consequence, we were able to set targets for those companies that will take them from where they are to where we think they should be by 2020 and beyond. Not all of those companies were happy with our approach, but at the end, numbers speak for themselves, and they were kind of hard to argue with. One of the other things we discovered in digging a lot deeper is that we're very customer friendly, which is kind of nice. But we were finding that if the employees had to choose between customer and Bilfinger, they often chose customer, which of course you tell to the customer when you're in front of them, but you don't tell to the board when you're trying to explain your results. I'll give you an example. In Germany, we have well over 1,300 customers in maintenance alone, and several hundred of those customers have annual revenues of less than 1,500 euros. Annual revenue less than 1,500 euro, right? So it's obvious what you do. You say, okay, that's very nice, but the maintenance costs just of writing invoices, we made that analysis in 2017. It takes us, costs us 12 euros to write an invoice. So you do that 12 times a year, 144, and not much of your profit on 1,500 euros is left. In fact, it's quite negative. So we're using our backlog momentum to be more selective on customers, or to use a financial technical term, I believe picky is the right word, okay? These plans that we developed with these key entities, they're not just, you're here and you should be there. They're execution plans, the way that you've got to know us. So we use BTOP for that. We set degrees of implementation, and then we follow through very rigorously to make sure that the delivery goes all the way to the bottom line. That's new for some of our colleagues, but it was highly necessary. We looked also at our projects and our products. And one of the things we did like is that we have high margin, high growth opportunities around 3 areas: biopharma and pharma, around energy, which is mainly nuclear and emissions, around the scrubbers opportunity, and we have opportunities around digitization and automation. So all of those areas are growth areas within Bilfinger, and they're not only growing at a double-digit rate, they also deliver higher, significantly higher than average margins, and some of them, especially scrubbers, also deliver good upfront cash payments. So we wanted to get more focus on that group, and this is part of the story I'm leading up to why we did some fine-tuning in our structure. I mentioned what we found in Block 1 in the procedure and deep dives. Not all of our managers survived those deep dives, and in the last 2 years, Michael and I and Klaus, we changed out of 200 top managers, we changed out 70, 35%. Yeah. And of those 70, 35 were internal promotions, one of whom is sitting on the left, and 35 were additional expertise we brought in from the outside. And of course, bringing in outsiders is always good because they bring new ideas, they challenge the status quo, and therefore, we term it management upgrades. I guess in English it will be the other definition of change management, but very necessary, and we continue to do so. We added to business development. We mentioned that at the outset of last year that we invested in expertise in each of the 6 focus verticals. We have the 6 industries, and that it's an additional cost, but I think you'll agree that our momentum, our development, and growth on the order intake line justifies that. So it's the right thing to do, and going forward, we're going to be doing that even more. And then finally, to support the execution phase of what I've just described in the other 2 blocks, we decided it was time to appoint a chief operating officer. When I say we, this is something that Michael, myself, the board talked about for a while, and we're very happy to find an insider, and I think after Duncan's given his presentation, you'll agree why. Finally, on our structure, what we've put in place is very strong governance, especially around project management. We've talked a lot about that in 2017 and 2018, and we're never going to give up talking about it because delivering project execution excellence is a key part to our story. We're doing it. We expect to be able to continue to do so, and therefore that's an essential ingredient that a company like Bilfinger just cannot do without. It's an imperative. We've been consolidating in country. Christina mentioned that. We have a good example in Austria. We're looking at other countries where it's not just a question of saving Sgna costs, because obviously if you have 5 companies merging into one, you only have one set of books to attest at the end of the year to put through the audit partners. But what it does give you is a much stronger management team. So 5 companies doing 60 million a year is very different than 1 company doing 300 million. And as we consolidate those companies, we will put in place newer and stronger management, again, to drive our plan going forward. Something else I liked, which we began in 2018 and continue to take forward, is working in teams. We're working in teams to generate integrated projects. Duncan will touch on one of those. But also we work in teams cross-border. What does that mean? We've formed Bilfinger turnaround concept. This is driven mainly by our teams in Germany and in Austria. But these teams work throughout Europe. So they are based in Germany and Austria, but they will equally work in the Netherlands. They'll work in Scandinavia. And we work very closely with our customers so we can actually dovetail, do end-to-end planning. And already today, our order book is full for 2019 for turnarounds. It's almost full for 2020. And the first customers have already secured our teams for 2021. So I think what I've described there is a continuing strengthening our sense of purpose, and it's something that we will drive forward what we committed to, but in a very tangible, measurable, and quantifiable way, not just we're here, we want to get there, not sure how to do it. We know what we're doing. As I mentioned, we haven't gone away or detracted from our strategy, our 2-4-6 strategy. It's nice to be able to explain that left to right or right to left, our industries, our regions, our service lines. What we have done is we put the technologies part, these are the producing companies I just described, we put them into one basket. We now call that service line technology. And we took the engineering part out and moved it into maintenance. And as such, essentially it's EMC. We've moved the E and the C into the M. And let me show you why we did that. And this is a slide I actually used internally when the colleagues asked the same question. So what you're looking at here is our European engineering resources. You recall that we have a number of companies, the largest of which is called Tebodine, based in Holland. Tebodine focuses on the European market, but of course one of their strong customers was NAM, the oil and gas company, JV, Shell, Exxon. And NAM, as you probably have read, scaled back their production significantly because of so-called mini earthquakes under the ground on account of fracking in the Groningen gas field. So we have a changing business there. And the PMC work, the project management consulting work that Tebodine was focusing on, is actually began to shrink from 17 to 18. You see here that the proportion of the other side of our engineering, that's the maintenance and modification engineering, is increasing. So the order intake, it's gone from being 26% of our 2017 orders to 30% in 18, mainly because it's growing, not because the other one is shrinking. The revenue, even a stronger position, but I think the one that's really telling is the last one, and that's gross profit. So 32% of our gross profits in engineering came from modifications in 17. That grew to 41% in 18. And on a year-for-year basis, you'll see bottom right-hand corner there that the change in gross margin was roughly 2.5%, 250 basis points in modifications, and it deteriorated by almost the same amount in project management consulting. So, we dive down very deeply. That's the message of this chart, and we take action. And the action was that, we're going to get more bang for our buck, again, to use a technical term, by moving this business into the maintenance area, having it work closer with our modifications team, and essentially giving the customer an end-to-end solution. We can engineer the modification and we can execute it. That's what many of our competitors do. They call it EMC. We chose the title engineering and maintenance, just to keep it short, or E&M is our new abbreviation. So going forward, I know it's not easy because you have to jiggle your spreadsheets, and I apologize for that, but it's the right thing to do for the business. And effective January the 1st, as I said, we've taken 2 service lines. So we took the engineering out of E&T, moved it into maintenance, so that became E&M. And when you look then backwards at what would those service lines have yielded in terms of EBITDA in 2018, I think it's quite a telling picture. So on the left, let's get the bad news out of the way first, just shy of 500 million in revenue, but a negative adjusted EBITDA of 24. I think that tells the story. Engineering is profitable, and when it slides over, it makes the right-hand side look very attractive. However, we did that not because we like to beat ourselves with negative numbers, but we said we've got to focus on the producing element. This part of the company produces package units, modules. The reason why the numbers are negative, there are 2 primary reasons. One is the fact that we have overcapacity in BET. BET is the entity that would ultimately service Hinkley Point. It's the entity that does work on Olkiluoto. And that overcapacity we kept intentionally as the customer kept delaying the Hinkley Point project. So that has a consequence. We did reduce headcount to some extent, but we kept a core team in place, and we knowingly went through the year with underutilization, overcapacity, if you like, and negative numbers. That will change in 19. The other major component of this is a company working in France where we had a lot of management change. Some of it was intentional, some of it's not expected, and we've now put in place new management. That company turned in a loss, and it will be turning in a profit in 2019. The other elements are solid. Some of you have followed our developments in biopharma, going great. Automation around the digitalization theme, also going good. What we also did was change the management in this division. Yeah, they're part of the 70 that I mentioned. Michael stepped in to be a placeholder and interim manager. We have a short list now, and we'll be putting a manager into T end of Q1, maybe beginning Q2. That manager, of course, then reports to Duncan in his capacity as Chief Operating Officer. On the right, we have our 4 regions in the service line, engineering and maintenance. In 2018, they would have added up to just under 3.5 billion euros. Good EBITDA, 133. As we go forward, of course, we will repurpose more of the engineering into maintenance. We will drive the margins. We will deliver on the improvements we've talked about. We will also have a good year in 19, 20, and probably in 21 in turnarounds. So I think also there it's the right thing to do. And again, through merging of entities, we're able to reduce Sgna and put in place stronger management to, again, take the business forward. I would pause there and hand it over to Duncan, who's going to show you how some of these things hit the bottom line.
Great, thank you very much. Thank you, my colleagues. Other than improving the margin and giving a sparkling presentation now, I feel no pressure at all. So thanks very much for that. Good afternoon, everybody. And could I also just say good morning, good afternoon, and good evening to all of our employees who hopefully are watching this today. And I hope you're having a safe day. So just a bit of background before I get into the main bulk of the presentation about myself. I've been with Bilfinger for 12 years, worked mainly in the industrial services line, and looked after Northwest Europe for the latter years. So I've been here throughout quite a journey, as I'm sure some of you have as well. I was speaking earlier to one of you about an analogy about a train. So I was here before the train entered the tunnel. I was here when the light at the end of the tunnel was a pinprick. Now the light has come really into focus, and we are nearly out of the tunnel. We are nearly back into the light. Confidence is back in the business. Delivery is there. Orders are up. Profit is back. Our people are confident again, and we will deliver the future. So let me tell you how we do it, because this is where we make the money. Yeah, this is what we do. And this is how I'm going to try and help make a difference with the rest of the team, the 35,000 people that we have working for us. And what do? We make incremental margin improvement. So the bulk of our business is framework contracts, engineering and maintenance. And we've been working on these sites for 25 years, some of them 75 years. Yeah, so we know what we're doing. And we can gradually improve performance year on year on year. That's what it's about in E&M. In the project area, as Tom talked about, it's about project delivery. And we've really strengthened our governance, so we go into the right projects, we make the right choices at the right time, we then manage the risk as we go in, and when we're executing, we do short interval project management. So we see the weak signals. Strong signals, we've lost money, are a waste of time. We've got to see the weak ones before it happens, and that's what we're getting good at. North America especially. They are really moving forward on seeing those weak signals. So very positive environment. Then we're going to look at a little bit more about what we're going to do in the future around higher margin work, where we're securing better portfolios, both in E&M and in technologies. The technology area has really moved on quickly. And that's also part of why we have the separation, so we can really see those products and we can engineer those products correctly and get them out to the markets, because it is a little bit different from E&M. We talked a little bit about cross-border, and this is where Bilfinger is quite unique. You know, we work right across the world, so we've got our four regions, Middle East, North America, the 2 in Europe, so Northwest Europe and Central Europe. And that's quite unique. So we can go with customers to various parts of the world and deliver the same services in the same areas and build on those strengths and reduce the risks for ourselves and those customers. So very important. We both reduce risk. It's a mutual journey that we're going through. And then, as Christina was talking about, we've got to get more efficient on Sgna. And that's throughout the whole loop, yeah, from start to finish, in headquarters and in our operations. And there's more to go at there. And that sense of purpose, that we do things for a reason, we do things for a purpose, which is to create money, is coming back into Bilfinger, and that is what we're going to carry on doing more of. But what's most important for us? Safety. People out there seeing will have been surprised it took me so long to get on to talking about safety, but operations is all about safety. Yeah, it is why we win work. We have to be world class. We are world class. We have to continue to be excellent. We don't work for Shell, we don't work for Exxon, we don't work for EDF without being safe. And that's what we need to continue to be, alongside very compliant culture, which helps in our discipline around project management as well, the compliance journey we've been on. So let's get into some examples, if I can get it going. There we go. Just going to pick on some examples in technologies and then into E&M and then some other areas we've done. And Tom's talked about some of these, so I'll only focus on certain areas. The scrubbers. What's the background to it? There's legislation in around reducing emissions that comes into play in 2020, middle of 2020. So we've got a good order book approaching there. So we'll have a lot of retrofits coming up to that where we need to get it on the old ships. And then after that, we're going to concentrate on the new build market, which is a nice consistent theme coming through. Yeah, so there will be an increase, then it will steady down into a nice steady level about that. We've got proven technology, yeah, which we've transferred actually from our old desulfurization on power plants over into ships, which is great. And for customers, it's actually very good. It's quite a short payback against using expensive fuel over to the scrubber systems. But what are we doing? We've been quite cautious. We've got a good order book, 100 million, 70 ships. And there's more options there. And we could already accept more orders. But we've got to get our production right. Ships come into a dry dock. You've got to be there. You've got to get the scrubbers on. You have a 2-week window. You sail out with it to commission it. Yeah, and if we're not ready, there's liquidated damages. So we are going to make sure our production is right before we start increasing our order book. And we will. And we're doing that to reduce costs as well, so we're doing it in different areas across the world and where the ships come into dry dock into China more often. So that's one area, good high margin work, a seller's market. A seller's market. Pharma and biopharma, an increase in market there that we see throughout with what's happening across the world with society and the products that are going in there. It's a global market with global players, and they buy on a global basis as well. And we supply on a global basis. Our facilities that we produce, so the production units are skids. We make a lot of them in Austria, and then we ship them around the world. We've just got orders in China, we've got orders in Russia. We are already the number 1 pharma and biopharma maintenance and technology provider within Europe. 22% or 20, roughly 20% revenue growth over the last 4 years. A good, strong platform to continue to grow. And we'll look at how we can take that onto a wider basis because there's, again, very good margin within those areas. Nuclear, Tom talked about it. In Germany, it's a different outlook, but across the world, there's a program on average for the next 20 years of 25 reactors being in construction at any one time for the next 20 years. There's still 450 roughly in the US and Europe that require maintenance, that require retrofits and upgrades to extend their lives. This is an area we've worked in for many, many years with Babcock Noel and BET as it is now. Right now, there's 3 new builds in Europe, and we're on all of them. Hinkley Point, we've talked about that. We've been on that project now for getting on for 12 months. We've got 20-odd people already down there. Fronted by a UK business, supported with BET. So set up a special company to do that. This is where we see, again, combined strength. German know-how, UK delivery. So it's through a UK company into the UK. That's the Brexit question out of the way, thank you. And where are we at the moment in that? We will be getting that order sometime in 2019, as long as everything continues as it is. We've already been nominated as the strategic supplier for the NSSS pipework within there. So we have a letter of intent. It is just now a matter of we are agreeing the scope that we do with that and how much other work we may do in that area as well. But not only do we do the Hinkley Point, we also do engineering for Framatome. Peter's business has been working in there for many, many years. Yeah, we do decommissioning, and we do handling systems as well. So it isn't just the specialist pipe work that we do. We do a variety of elements within that. And we wouldn't be winning that work if we weren't safe, if we weren't giving high quality, and we weren't delivering on time. Because you cannot get away with that in the nuclear industry. And that's what we do. Let's talk a bit about engineering and maintenance. The Fluxys project, €36 million project, very good example. This is about odorization, deodorization of gas, about when you take gas cross-border from Germany. So you take in odors and take out odors because of the different legislation that you have in different countries. And we've got very, very good technology in that and very good experience in gas. And we brought together here 4 companies from Bilfinger. The engineering people, the fabrication people, the installation people, 2 installation companies, to bring that together and deliver it. Now, a few years ago, we probably wouldn't have done that. But we're working together because we are far better family, far better cooperation, and approaching this one Bilfinger mentality, where 1 + 1 = far more than 2. Because that's what, again, we need to do to grow. Tom already touched upon the Bilfinger turnaround concept. It is my background, and a lot of our colleagues work in this. And this is one thing we can transfer across. It's the biggest single risk for the bulk of our customers every year. We'll be doing the largest turnaround in Europe at Shell Moerdijk, which will be starting later on this year. And we'll have 700, 800 people on that turnaround. And we need to deliver. You know, the profitability of that site is exceptionally good. It's shut down for 5 to 6 weeks. I can tell you exactly when we finish the schedule. And if we do not deliver that with the customer on time, their profitability is hit. And they rely on us, and they've relied on us on that site for 25 years to do that with them. Yeah, because we're reliable, we're safe. And that's what we're going to deliver again. One of the other areas, corrosion under insulation. We do a lot of insulation, we do a lot of scaffold. It's a big part of our business. It's a profitable part of our business. This particular area where you get scabbing, corrosion under the insulation of pipework, especially on oil rigs and in the petrochemical refineries. This accounts for 60% of the hydrocarbon leaks across the world. So when we have big process safety issues, this has caused a lot of that. So this is why there's an investment program across the US and Europe where you've got about 250 refineries of about $2 billion euros. And we're getting access to that market because we've got all the services able to bring that together and do it very efficiently and save the customer between 60 and 75% of their cost through putting rope access technician teams together. So we'll have a rope access inspector doing NDT, we'll have an insulator, and we'll have a painter and blaster, all in one team, working off ropes. So they'll do the inspection without taking the insulation off. If we find a problem, we'll take the insulation off there and then, and we'll correct the problem, find and fix. And it removes a massive amount of the cost. You don't have to put up scaffold. You don't have to go back, get other people in and do different elements. And this is providing real value, and hence we can do more and more and more. Save the customer money and give them our higher value services. So we're shifting it around, which is what we need to do, provide these solutions to customers to deliver higher margin services. The last one I've got is, people may not have remembered, this was one I showed, I can't remember whether it was back in October 2017 or whenever it was. I thought we were at a worse time, but whatever. This was a contract we did. Not all contracts start off brilliantly. We won this contract on an offshore rig, just checking there's nothing there, back in January 2017. And it didn't start off very well. Yeah, it was at the time the market was tight, our Norwegian business needed to win work, and we went in a bit tight. But we worked very hard to bring it back. I remember we talked about here, and we started to bring that back. And we maintained this profitability throughout, and now this contract is very profitable. How did this happen? Measuring our performance. So here, this is all about the norms, so how quickly we do work. That's how we get paid on the bulk of our contracts. Yeah, we get paid for what we do, not how long it takes. So we've got to drive that efficiency. Yeah, you know, our people, it's a lovely day today. Our people are out there working when it's raining. They're turning up at 5 o'clock in the morning. They're walking down to the site. They're getting wet through. They're getting changed. They're getting out there. They're getting briefed for their work. They're getting their permit. They're going to the job site. They're checking their PPE. They're doing their last-minute risk assessment. And then they're starting and delivering work. That is our lives. And that's what we do well. And that's what we look at making more and more efficient. And it's getting down to this incremental level of that bit of performance improvement every day that we can do to make a turnaround like this. This was done with only Bilfinger people. No consultants, just Bilfinger people. Because we're the experts in delivering this in production improvement, productivity improvement. So, at the end of that now, how are we going to go forward on this? A lot of what I do is about what we do as strategy and transferring that to then how we deliver it in the field. Because that's the key. What we do, we've been doing it right. We need to get better at converting that how. And how we do that in North America can be very different to how we do it in the Middle East, or how we do it in Central Europe or Northwest Europe, and on different sites. And that's what I need to do with my people, that we're working together as a team and doing this better and better and better. What do we do to make sure we're doing it well? We measure it. The facts don't lie. Measure it, put a plan in place to improve it, and deliver that plan, and then go back and check it, and check it, and check it, and check it. Because the facts don't lie. And that's how we move it on. And behind that as well, we've got a very good product portfolio now. You know, we've got high margin services, we've got high margin products that we're bringing through to the customers with a good order book behind that to deliver it. So from a delivery perspective, from what's happening out there where we're earning the money, we've got a very positive environment. We're a safe business. We've got all the tools and techniques to deliver efficiently. And we manage our risks and get ahead of them by looking for those weak signals. That's what we need to do. With that, I'll finish. Tom?
Good job. Thank
To
you. Thank you, Duncan. So it's up to me to try to round up with a look ahead and how we're going to do in 2019 and beyond. It's interesting because, you know, from the beginning of the year, already at the end of last year, but certainly the beginning of this year, we've done quite a lot of conferences. And we're always asked, you know, do you see shakiness in your industries and your customers? And the answer is no, we don't. And you know, why is that? Well, you know, our three key industries are oil and gas, chemicals and petrochem, and energy and utilities. They make up, as you recall, 80% of our revenue. All of these are right now very robust. They're long cycles, they're late cycles. You know. So if something were to materialize, we will get plenty of warning, and then of course we would have to adapt and adjust. You know, that's not the case. And if we go very briefly through our, you know, 4 regions, you recall that Northwest Europe on the bottom, this is mainly the activity around the North Sea. So, you know, UK on one side, Norway, Scandinavia on the other, and then Holland in the south. The northern part, continental Europe, is therefore mainly about, you know, downstream oil and gas. And here we see people investing in maintenance and field life extensions. So investments are sunk and assets are run for cash flow. We see upgrades along the European gas network, and the gas network, you follow it the same way everyone else does, is in some cases aging, in some cases being expanded. So Nord Stream comes into Lubmin, it has to go on to the rest of Germany. LNG plants are being talked about not in terms of liquefying the gas, but in regassing the liquid. So we expect in this year and next year there'll be an announcement to one of the 3 locations, and then again gas infrastructure comes into play to bring that imported gas into the structure. So we think oil and gas, continental Europe is mainly around infrastructure, and we're well positioned, and you saw, I think, the Fluxys project is evidence of that. In chemicals and petrochemicals, our customers are doing well. I would say ammonium fertilizer is the weak area, but all other chemicals, specialty chemicals, base chemicals, these are good business lines, and the customers are continuing to put money into their plants to drive performance and productivity. There's not so much expansion, at least in continental Europe as we know it, but people are investing their money and driving performance. Energy and utilities, Germany is interesting. You read about the coal-fired power stations that will be turned off. They produce not only electricity or energy, but also they produce hot water. So the combined heating, as it's called, then leaves consumers without a source of hot water. That's where district heating comes in. And these are projects that are well within the scope of Bilfinger, within the BET organization that we mentioned. And we're actually executing a project in Mannheim where we do exactly that. We replace the warm water from the coal-fired power station that's being shut down with a separate generation process that then delivers heating to the homes around Mannheim. I think on the far right, pharma and biopharma, I've talked a lot about. This is a good business. We're taking it to China. We're opening our office in Guangzhou to support business there. And I think you will also have read our first move into Russia, where we've sold quite a large skid towards building a new biopharma plant in Russia itself. Northwest Europe, so North Sea, this is the oil and gas part of Bilfinger. And again, we're asked often, because the people see a very strong correlation of our share price to the oil price, how much of your business is actually true oil and gas related? And it's around 15% on the upstream side, maybe another 5% downstream. So we're at 20, maybe a little bit more depending on the seasonality and on the cycles. But here definitely it's our upstream business. The North Sea is good. Customers are making money. Last year, customers, oil and gas customers typically budgeted for an oil price of around $45 to $50. That's the same this year. These customers are not changing their plans when the price of oil moves from 65 to 55 and back to 60. They just record a high windfall profit. And I think you saw that in the numbers from Shell and BP just a few days ago. Chemicals and petrochemicals, or the downstream business, is also prevalent in Northwest Europe. This is the metropole, if you like, the chemical metropole between Antwerp and Rotterdam. That is actually the 3rd largest chemical complex in the world. Number 1 is in China, number 2 is in Houston, number 3 is in Antwerp, Rotterdam. And you will have read that INEOS is investing there in beginning 2019, a $3 billion investment to build out a new facility there. So there are things happening even in mature markets. Hinkley Point, Duncan touched on it. I won't dwell on that. We're there. We're working there. So our people are inside the customer's organization. We're working on our project on an hourly basis, which is very nice because that's guaranteed profits. But as we go forward, we will sign the larger contract. It's going to be 250 million. It was supposed to be last year. The customer changed some structures. They asked us to be patient. They gave us a time and material contract, and somewhere this year we will sign that contract and then record a one-off lumpy order, but that will turn into revenue over successive years. So again, it gives us strength, visibility, and improving margins. If I jump to what we call the developing or international, because the other two there I just reported on were Europe. In North America, things are also good. In North America, we have a strong, C component, the EMC, engineering, modifications, and construction. Our business in North America is very construction heavy, but it's constructing mainly in the midstream. And what is midstream? Oil or gas comes out of the ground at the well side. It's got to get to the refinery. So midstream is all the technology gets it there. It can be pipelines, it can be LNG, but it can also be cryo units. And a cryo unit is the refrigeration process where gas comes out. Through refrigeration, you separate the liquid component from the dry component, and that liquid component is what then goes into the crackers to create base chemicals, polyolefins, polypropylene, and so on and so forth. That is a good business. A lot of investments still yet to come in Texas, Louisiana. We were there with the press a couple of weeks ago, and people talk of a $200 billion investment, dollars, not euros, but it's probably very similar, of which only 80 have been made so far. So, another 100 billion to go. We like that. Even a small part of that is a lot of money, and so we think we're in the right place at the right time. In the Middle East, oil and gas companies are picking up. The national oil companies, the NOCs, are investing again. Not only are they investing, they're making announcements. And the mentality there, they don't announce unless they intend to do it. So we've seen really good opportunity in Abu Dhabi. We've been working with ADNOC for a long time. They want to invest in the build-out of their refinery in Borouge. They talk of a number of 42 billion. What's going to be at the end of the day is something close to that, but it's going to be big. And we're already there working with ADNOC in Borouge, so we're ideally placed. They've also mentioned increasing their oil production. So, the OPEC, non-OPEC play continues. But at the end of the day, depletion, reducing pressures drives the need to replace reserves. So we're not talking about, increasing production, but merely replacing what has disappeared during the course of a year. And their aspirations have gone from, the 3 million barrels a day to 5 million barrels a day. It's another $120 billion required to do that. So money is flowing, and why? Because, again, they're making a lot of cash, even at oil prices in the range 55 to 60. I think, we're in good markets. We are in robust markets. We have, solid customers. And therefore, although we can read about recession and in other industries, we don't feel that. And we don't feel it yet, okay? And we don't feel it in 2019 either. Now, that might change, but we're confident. And that confidence, allows us to then stick our neck out just a little bit, not too far. The numbers you're familiar with right now. So in 2019, we think we can continue to grow. We've got good backlog, 12% increase in backlog year over year. We still expect to be book-to-bill greater than 1. There may be some quarters where it dips because, we're showing some very good track records. But overall, we expect mid to single-digit organic growth in 19 over 18. Our EBITDA will grow also for all the reasons you've heard. We're driving performance, we're driving productivity. We continue to take down Sgna, and therefore, we set ourselves, if you like, a baseline at 100 million EBITDA. We're going to do better than that. So a significant increase to more than 100 million EBITDA adjusted. Finally, free cash flow. It's reported now, not adjusted. We were close to break even in 2018. I'm glad we weren't in some ways because we want to put that check mark next year. But of course, free cash flow is important. It's what drives the business, and I think it's also, number one priority of Christina, as you heard during her presentation. So, we have good momentum. We see ourselves going forward, and there's no reason why we should, retract or change our aspirations that we shared with you in 2017 with the Bilfinger 2020 strategy. We said at the time, it's a long way. It's hard work, and yes, definitely is hard work. I think the whole team is nodding. Yet, we set ourselves many small successes along the way. That's important to record these successes. And in Q4, we added one more green tick mark on the adjusted free cash flow positive latest in 2018. We deliver. we haven't changed this slide to meet our results. So going forward, I think you've seen our aspirations. We're on track, and we will do that. The refinancing, that will happen very soon. And of course, the refinancing is going to be our target, our next check mark. And the cash flow development obviously helps in that regard. We did make one adjustment in our slides. Again, this is an old slide from 2017. So we said taking 17 as the base year, we would grow the top line, 5% CAGR, check mark, we're on track, good book to bill, good order intake, and a strong development in the backlog. We said that we would increase profit from a 0 effectively in 2017 to an adjusted EBITDA of roughly 5%, of which 2% or 200 bips would come out of gross margin, 300 out of Sgna. You've seen we're well on the way. But going forward, if you ask me what is my measure of success going forward, and I think Duncan's too, it's driving that gross margin now, driving it forward through all the things that we discussed, not only performance, but also the fact that we have good products with higher margins where the market is demanding those products. We have to execute, deliver on time, and then make sure those higher gross margins come all the way through to the EBITDA line. On the cash side, I think we've said enough. And sorry, I should add one more point. I said we added a line here. It's including portfolio rotation. What is that? Something we began talking about at the end of last year. And you recall my slide where I talked about the analysis. When we went deeper into companies that were, in our view, underperforming, we found improvements, we found fixes, we set timelines and actions and dates and people. But even then, they will only get as good as their peer group. We don't see them going above a 3 to 4% EBITDA. And for that reason, we said, once we've got them to what we think is a good benchmark, a peer group comparison, we will then sell them. And from the proceeds, we will buy other companies that do fit our margin profile. And that is why we did introduce here on the profit box, it's the only line, I assure you can go back to 2017 and check, it's the only line where we said we now include portfolio rotation. And that's going to be small things. It's not game changers, but we do want to spend the money we get from selling the accretive entities, the 4 that Christina mentioned, and a few other fine-tuning in our portfolio. Okay, cash we talked about, return we talked about. So I think we're on track. We showed in 2017 that we've turned around the top line. Yeah, so inflection point achieved, orders taken in, revenue taken in. In 2018, we have the inflection point on EBITDA and on cash flow. And as I mentioned, a solid backlog going to 2018. We're confident. We think we're able to deliver, and we think we will meet our 2020 ambitions. So with that, I would say thank you, pass it back to Bettina, and I guess open the floor.